All right. Thank you, Liz. And thank you, everyone, for joining, whether now or in the recording later. As Liz mentioned, I'm Jason Valencia. I'm a CFP and then a wealth advisor and partner here at DVB Financial. And then also on this Zoom is Kimberley Kuczawa, who's our special needs family coordinator. We, like Liz mentioned, are DVB Financial. So we're a wealth management, investment management firm here located in central Pennsylvania. We have offices in Harrisburg and York. And we've worked with a lot of local businesses in the area for decades, and working with helping people retire and transition into retirement. And over those years, we started to work with families who had individuals with special needs. And so we started to get into this place naturally just by working with some of the families through retirement transition. And through that process, we began, I think, to discover that there were some holes out there, and that as parents, um, maybe you weren't getting the best support you could have gotten, or there wasn't that piece there to tie all the pieces together between maybe what your support coordinator is doing and what the uh, attorney's doing and what you're hearing online and what your friends and family are doing. So you hear all these different things, but there wasn't someone there to kind of tie everything together. So a few years ago, we hired Kimberly to be our special needs family coordinator to really develop an offering that was specifically built for families with disabled individuals. So we call that Independence and Beyond, and it's our planning and wealth management service designed for, like I said, families with special needs. Myself and my partner Mike do a lot of the financial background, the classical financial planning, wealth management, but Kimberly really works alongside the families and there are other trusted resources to develop a transition plan for that kid, whether it's an adult child who's leaving school and what their life's going to look like beyond school, kind of partnering with what some of Liz does at Vista, but really then the long-term plan of what the next 10, 20, 30 years looks like, what that kid's support system is going to look like, maybe as you're not the primary caregiver down the road, and what those housing options can look like. And our goal is really to start to plan for those things, not only financially, but also start to plan for those things from an emotional and really lifestyle standpoint so that one day when things change, because they do change one day, it's not a sudden shock, and that there's been some gradual progression towards whatever those big goals are. And so that's just a brief overview of how we work with families. If you have any questions, feel free to reach out to us. Um, but that's who we are, and that's what Independence and Beyond is, and what we've built over the last few years. So getting into ABLE accounts, these were really created in 2014 through the Achieving a Better Life experience. So that's where ABLE comes from. Synonymous with the government is synonyms, and so they had to create something. So Achieving a Better Life Experience Act, and they were really modeled and piggybacked off of 529 plans. So as I go through this presentation, both Kimberly and I am going to make some reference to 529 plans. Some of you might be a little bit more familiar with how they work. And accounts were basically built off of the structure of 529 plans. So sometimes you'll even see an ABLE account referred to, depending on the state, as a 529A account. And so if you see that A at the end of 529, you know they're going to be talking about an ABLE account. So what does it really do? It provides a tax-free savings for individuals with disabilities without impacting government benefits. So what it allows you to do is it allows you to take money that you've already paid taxes on. So, you get your paycheck after your, whatever retirement plan, put it into an ABLE account, and then that money will grow tax-free until you use it. And as long as it's for a qualified disability expense, you will never pay um, you will never pay taxes on that growth, and you won't pay taxes on the distributions either. If that money does grow and you end up taking it out, you would, without for a qualified disability expense, you would pay taxes and potentially a penalty on the growth of that money. But so long as it's used for a QDE, you don't have to pay any taxes on the growth of that money. So that's the real advantage to it. Again, similar to a 529 plan, you put money in, you grow it. As long as you use it for education, you never have to pay taxes on that growth. So these plans are available in really 46 states. I mean, all 50 states use them. 46 states have in-state plans for them. Pennsylvania is one of those states, so you'll see Pennsylvania referred to as PA-able. I'll get into this a little bit more, but there is some benefits that Pennsylvania offers. to open up an in-state plan. Should you want to open a plan versus an out-of-state plan, you can open up out-of-state plans if you'd like, but Pennsylvania does offer some benefits that are beneficial if you're a PA resident and you're going to open it up in state.
Okay, eligibility for ABLE accounts. So an individual must have a qualifying disability that was obtained prior to age 26. This is changing in 2026 at the start of the year to age 46. So individuals who obtain a disability later in life will have access to ABLE accounts starting next year. If an individual is receiving SSI or SSDI, they are automatically eligible for an ABLE account. With that being said, you do not have to be receiving a benefit to open an ABLE account. There is an option to self-certify, which just requires proof of disability from your physician. So once you apply, you just submit that as well. Contributions into an ABLE account, so they align with the federal gifting tax limits. So for 2025, $19,000 can be put into an ABLE account. These contributions can really come from anywhere, family, friends, special needs trusts, Social Security, things like that. 529 plans are even able to be rolled into an ABLE account. It's just important to note that all contributions must be under that 19,000 for the year. So if you have a, $100,000 529 plan, you can only roll over 19,000 on an annual basis. Management of these ABLE accounts, so it can be managed by the individual or an authorized individual. Authorized individuals being somebody who is close to the individual, understands their situation. It can include parents, guardians, power of attorney, representative payees, even siblings, grandparents. When applying, you will have to submit a proof of relationship to the individual before becoming an authorized individual. In the account, any balances over $100,000 can affect government benefits, specifically SSI. ABLE accounts, PA ABLE also offers 7 different investment options and a checking account option. So when you're opening an account, you have options as far as investment allocations go and things like that.
Yeah, that's one of the differences between when I talk about the different state plans. PA Able uses the same back end as PA 529, so if you're familiar with that at all, but really it's a Vanguard investment lineup, and they actually make PA Ables a little bit more vanilla, I'll say, than even PA 529 plan. So you really have a few different asset allocation options. You can basically choose, aggressive, growth, balance, conservative, like ultra conservative, and then the checking account option. And that's one of the differences between the states. So if that was more important to you as far as the investment options inside of a plan, you go to a state like Maine, they're going to use BlackRock funds, and you may have access to some more investment options. You go to Virginia, they're going to use American funds, and you're going to get access to some of American funds, mutual funds. So depending on what your goals are, there could be reasons why you would go out of Pennsylvania. I'll say this, Pennsylvania does give you the state income tax deduction up to the $19,000 a year, similar to the 529 plan. So if you put $19,000 away or $5,000 away, $1,000 away, you're going to get that state income tax deduction for those contributions. The other benefit that Pennsylvania has for their residents and PA able accounts, which is different than some other states, is there is no Medicaid clawback on your PA able account. Whereas in some other states, or if you don't have a PA able account, there could be. So um, at the end of the day, when the state comes to look and see how much maybe they supported that individual, um, some states would require that if your account was over a certain amount that the state can actually recoup their Medicaid costs. Pennsylvania does not allow that. So to Kimberly's point, you really want to, the big number that you want to think about is $100,000. If you get over that, your SSI will get suspended. It's not going to get eliminated, but it will get suspended. And so you want to get the balance back below that. If you're not on SSI, and or your child's not on SSI, maybe they've transferred to SSDI because you're taking retirement benefits, or neither of those apply, but they're disabled and not on either of those benefits. There are other income limits that will begin to apply that that may affect waivers and HUD and some of the other benefits you might be on. Those vary, but they get up to be more about like $300,000 in the account. But really, the main one is 100,000. You're gonna SSI is gonna be suspended. So distributions, you've put money into this. It's grown over the years. Really, why do you put money into it? What can you use it for? And so again, I talked about those qualified disability expenses, and you're going to see a lot of different definitions out there for them. It can be a little confusing, but generally speaking, anything that helps a person with a disability improve their health, their independence, or quality of life is going to be considered a qualified disability expense. You can go on to paable.com or ablenow.com. There's a lot of websites out there that are going to give you pretty comprehensive lists on what is a qualified disability expense. But again, health, independence, quality of life. If you can fit it into one of those three buckets, you're most likely good. So basic living expenses, food, clothing, education, housing, transportation, assistive technology, traveling to go see family, right? That's going to be a quality of life thing. All of those expenses, as you put the money in and it grew, you can take out, pay for those expenses. It's not going to affect your government benefits, and it's not going to, you're not going to pay taxes or penalty on the growth of that money. So it's a great way to use these accounts, and what makes these accounts unique, I'll say, versus a special needs trust, right? And not to get in the rabbit hole of the differences between all of these, but really the difference between these and a special needs trust is a special needs trust cannot pay for basic living expenses and housing. And that's really the limitation of a special needs trust. It can't pay for food, basic clothing, or housing. An ABLE account can. And so that might be a reason why you have both, or why you would prefer an ABLE account over a special needs trust, because the ABLE account can pay for some of the things that SSI does cover, where a special needs trust can't. And then as far as distributions work, it's going to depend on the state you open it in, but generally pretty flexible. Online, by phone, debit. You can have a debit card attached to it. You can write checks to it. And then PA ABLE specifically doesn't require annual reporting for proof of QDEs, but very good practice to keep receipts and to track your distribution. Should SSI come back and try to claim that you had more money or that you were ineligible, those receipts can make a big difference, if you were to get audited. Some other things to consider, just I guess some more unique facts about ABLE accounts. So there's one account per individual, unlike a 529 where potentially you could get away with having a couple different accounts. Maybe the grandparents open one, maybe you open one. ABLE accounts, there should only be one account for the individual. It must be opened by that individual who's also the beneficiary, or by the authorized individual, which Kimberly discussed a little bit earlier. Funds can be transferred in between states. So say you open an ABLE account in Virginia and you're like, hey, I like some of these benefits. I moved. I'm in Pennsylvania now. Or I opened it in Virginia because it was a 529 plan, but I want the benefits that Pennsylvania's offer. I'm a Pennsylvania resident. You can transfer those funds into, between states. Most states allow that. The majority of states allow that. And then one other little caveat, if the individual is working, and they're not eligible to participate in the company's employer-sponsored retirement plan, or the company doesn't have an employer-sponsored retirement plan, you may be able to contribute more into the ABLE account than the $19,000 through what's called able to work. So this really allows you to put away income into the ABLE account up to like the federal poverty guidelines, and it's going to depend on how much you make, like how much you actually are earning. But I believe the excess can be up to like $13,000. So you can put away that initial 19, and then you can put away close to 13 or $14,000 of additional money if the individual is working and not eligible to contribute into a retirement plan. If there is a 401k offered and they're eligible, even if they don't choose to participate, they would lose that ability to use the able to work guidelines. But that's just another thing to consider. Like, hey, the individual has a great job, they're earning good money, 20, 30,000 bucks a year, but we still got to keep them eligible for these benefits because they're critical to their lifestyle. Well, consider able to work, and maybe that's a way that you can, the individual can earn some more money, but this is a way to shelter that money away.
Benefits of ABLE accounts, they're easy to open, especially when comparing them to a special needs trust. Accounts can be opened online. Only a small initial deposit is needed to open an account, can be as little as $25. And of course, there's no attorney required in opening an account. Funds grow tax-free for those qualified expenses. And this is also a good tool for SSI recipients. If you're a representative payee and you see an individual is getting close to that $2,000 limit, funds can be moved into an ABLE account to protect eligibility for those benefits. Also, if an individual is subject to back payments from Social Security, those funds, if they're not spent down in that 9-month time frame, can be placed into an ABLE account. And then if an individual is applying for things like SSI and there are funds in their name, if those funds are moved into an ABLE account, then the individual is exempt from that look back.
Some of the limitations of a label account, and really we're talking a little bit compared to a trust here of what the differences are. You have the contribution limit of $19,000 a year. You're limited to that $100,000, especially if you're concerned about SSI. The distributions are limited to the QDEs. And so if you take a distribution and it's not a QDE, not only are you worried about taxes and the penalty, but SSI is going to look at that as now potentially income because you didn't use it for a qualified expense. So you're limited in the way you can use it, and then investment options are going to be limited to whatever the lineup is for that state. And so compared to some of these with a trust, obviously a trust you can put as much money as you'd like into it. The investment options are whatever you'd want them to be. Your distribution options are limited, so but different in a different manner than they are with an ABLE account. They just, from a trust, you can't use it for things that SSI is paying for, like housing, food, and basic clothing. Um, and there's no contribution limit with the trust. So we're going to run through a couple scenarios here in a second, but to give you guys an idea of how we use these, you know, they can be great as standalones. Like Kimberly just gave a couple great examples. You're in a pinch, you just got an SSI back payment of $10,000 because you got back paid from whatever 5 months ago. Really easy way to handle that is to open an Able account and put the $10,000 in an Able account, because you know the QDEs aren't very so restrictive that you would never be able to get this money out. Some people worry, well, like how will I ever get this money out? Well, you can use it for medical expenses. You could use it for housing. When we talk about housing, that's a down payment, that's mortgage, that's rent, that's utilities, gas. Like there's a lot of reasons why you could use this account. Same thing with transportation. You can use it to fund Uber. You could use it to, pay for a Lyft. You can use it to, if you're, like I said, traveling to go see family. There's a lot of reasons you could use it. So, um, you know, we may tell some families you don't want to overfund it depending on your specific situation because maybe you're not going to have a lot of these expenses and maybe a trust would be better. But if you're in a pinch and you're like, hey, I got to get money out of this individual's name, Enable account's a lot simpler than a first party special needs trust, which is really your other option, um, your other main option if you want to leave the child as the beneficiary.
And then going through some of our scenarios, we have an individual that receives SSI and Medicaid, wants to save money for the future, but asset limits prevent an individual from saving in a regular savings account. So an ABLE account in this situation can be used as this individual's primary savings account, can hold those excess SSI funds. Family members can contribute directly into the ABLE account. Um, and then that protects the individual's eligibility because it does not count towards that asset limit. And then the individual is able to use the funds for things like we talked about transportation, traveling, adaptive technology, things like that.
Scenario two. So this is one we've seen a few times now, with clients. You were a family that's from the early on was like, hey, we're going to put money in 529 plan, save for our children's education. Um, as you get a little bit older, you're like, hey, maybe for the one child who has special needs, these funds need to be a little bit more flexible. You can transfer those 529 plans, like we said, into an ABLE account up to the $19,000 a year. Or you could also change the beneficiary on that 529 plan to somebody else. The cool thing about ABLE accounts is you're not giving up the ability to use that money for education. Education is still a qualified disability expense. So just because you're moving it from a 529 to an ABLE doesn't mean that if your kid's going to go on to education or a certificate program or professional program, you can't use that money for those things. You can. You're just opening up really what else they can use it for some of those other expenses that a 529 plan can't use it for. So it's less restrictive from the 529 plan as long as you're eligible to meet those, um, to meet the eligibility criteria to open the account. Um, and so that's another way we use it. Like we'll see them used. You've grown these 529 plans. Maybe all your other kids are through college, so you can't go use it for another education expense. Well, you can either leave it in the 529 plan, and change the beneficiary to someone else, maybe do some estate planning, change it to a grandkid down the road, or you can start to transfer some of that to an ABLE account. Another reason we'll see ABLE accounts used or start to get funded down the road is maybe independent living is a big goal for the individual. And right now, maybe they're living with you guys in the parents' house, and down the road, they're going to want to live independently, whether that's renting or buying a house. That's a situation where you might want to, if you have the assets, you're going to look at funding a special needs trust, but you're also going to look at funding an ABLE account. And what's actually cool is these two things can work together. So every year, um, the special needs trust can issue a distribution up to that gifting limit of $19,000 to the ABLE account. And so say the individual lives in an apartment that maybe is a little bit more than what their SSI and what their income can cover, but that gap can be covered through what's in the ABLE account. You can use the special needs trust to hold the larger amount of assets and every year transfer whatever that amount is. If it's 10,000, you need excess 15, 20,000, up to the $19,000 limit. You can move that money from the trust over to the ABLE account, and that can help supplement housing expenses. So, um, as we go into the resources, if you guys have questions really on what is, unique to your situation, like here's what we got going on, ABLE accounts can be great. We don't recommend them for everyone because sometimes they're not needed. They're not the most efficient vehicle to have the money. But in a lot of the situations we mentioned, they can be a great place to fix some short-term issues. They can be a great place, maybe for some longer term planning as you sit down and start to think about what that longer term picture starts to look like. Maybe ABLE accounts come into the picture. And then again, if you've saved up 529 plans and you need a place to put them, you don't want to pay the taxes and the penalty, an ABLE account can be a great place to use them because, like I said, those qualified disability expenses can be broad. You can spend them down over time and start to get money out of that plan.
So then when it comes to applying, it can be done online. For Pennsylvania, you would just go to paable.gov. You can complete an online application or print out a paper copy. They also have a support line, which is very helpful if you have any concerns or questions before opening an account, or if there's an expense that you're unsure of. Feel free to reach out to them. And also, I listed my email there as well. So if you have any questions just about DVB or your situation, please feel free to reach out. We're happy to work with anyone. Jason, anything else?
No, I think that's it. Like I said, if you have questions specific to your situation on ABLE accounts, or you're unsure, should I open one, should I not? Feel free to shoot Kimberly an email. We can set up a call and just go through your situation and talk about, how this would benefit you specifically as a family, things to think about, things to consider, um, you know, short term, long term. So that's what we're here for, and we're happy to help.
Thank you. Are there any questions now? You can put them in the chat if there are. Oh, we did get a question. Cost. Cost associated, any cost associated with opening a PA able account?
Off the top of my head, Pennsylvania will charge an annual like admin fee, but I want to say it's like $40 a year. And if your balance is below a certain amount, they don't charge it. So if you put $25 in to fund it, you're not going to get charged for it. The cost for investment options is pretty low cost. Like PA is one of the cheapest able accounts you can open. Like if you get into some of those American funds, you can get into some higher fund costs. But I want to say it's like a $40 expense once you're over a certain amount of a balance. But
Great.
I can shoot Liz an email with the correct answer there.
Thank you. We did get another question. Can proceeds from a life insurance policy go to an ABLE account?
That's an interesting question. You would be restricted up to the $19,000. So the proceeds from the life insurance would have to be less than that $19,000. I would say they're probably better suited going to a trust and then maybe that trust funding the ABLE account. But I actually don't know the answer that if you could actually list the ABLE account as a beneficiary of the life insurance policy. It would probably be the individual would be listed as the beneficiary and they'd have to put it in the ABLE account themselves. So I think the answer to your question is no, but again, I can confirm that and reach out to Liz with the correct answer. Good questions.
Yeah, that was good questions. All right.